everyone, welcome back to another video. In this lecture, we're going to be talking about balance sheets. So here's a quick review of the accounting equation. The accounting equation states that assets equals liabilities plus equity. And here are some key terms I want to review quickly before we dive any further. So revenue is the income that a business makes, and it's primarily made through the sales of goods and services. And expenses are the costs of the revenue and the costs of the operations incurred to get that revenue. And dividends are a portion of the profits that are allocated to the shareholders. So they're given back to the shareholders. And capital contributions are capital. So this is cash, loans, etc. that is invested into the company in exchange for a share of that company's equity. And equity is a representative of ownership in the company. So the total value of equity is calculated using the accounting equation. So you subtract the liabilities from the assets of that company. And here's the accounting equation expanded. So we start with our simple assets equals liabilities plus equity equation. And we can break up equity into capital contributions, retained earnings, and we can break up retained earnings into net income and dividends. And we can break up net income into revenue and expenses. So here's how we read a balance sheet. So we have our current assets at the top left. And these are just assets that can be converted into cash or liquidated in less than a year. And then we have our current liabilities right beside it. And these are the liabilities that need to be paid off in less than a year. So they're the liabilities that correspond to the current assets. And then we have our liabilities payable, which is just debt that the company needs to repay to the lenders. And this can include accounts payable, interest payable, and notes payable. So now let's look at financial ratios. So there are four main types of financial ratios. So the first one is profitability, which reflects how well a company can generate profits. And then we have liquidity, which reflects how well the companies can pay off their short-term debts with their assets. So how liquid the company is. And then we have our efficiency ratios, which indicate how well a company can use its resources to maximize profits. And then we have our solvency ratios, which just reflect the position that a company is in. So how well positioned, well placed it is to pay off their long-term debt. And in this video, we're only going to be covering liquidity and solvency ratios. So let's start with liquidity. So we have our current ratio, which is our total current assets divided by our total current liabilities. And generally, the rule of thumb is that good current ratios have to be between 1.2 and 2, or they can be greater than 2. And for our example, our current ratio is 89,000 divided by 61,000. So that's 1.46. And the way to interpret this is that for every $1 of debt that the company has $1.46 to pay it off. So it seems to me that they're pretty well placed. And the next ratio is the quick ratio. And these are all the assets that can be quickly liquidated, divided by the current liabilities. And these assets include short-term investments, accounts receivable, and cash, and many more. And a good quick ratio is greater than 1. So for our balance sheet to the left, the quick ratio is 0.866. And since that's below 1, it's not a very good quick ratio. So here's some practice. So I want you guys to find the current ratio, and I want you guys to find the quick ratio of this balance sheet, and then explain whether it's good or bad. So I'll give you guys about a minute to do that. Pause the video and unpause when you're ready. So here are the answers. So the current ratio is 3.17, and that's good because the current ratio is very high, and that indicates that the company is very liquid. And the quick ratio is 2.77, and that's good because the quick ratio is above 1, and that means that the company is very liquid. So now let's talk about solvency ratios. So the first one is called the debt to equity ratio, and this is the total liabilities divided by the total shareholders' equity. And in our balance sheet to the left, the debt to equity ratio is 1.66. So good amount is between 1 to 1.5. And the next kind of ratio I want to talk about is the debt to asset ratio. And this is the total liabilities divided by the total assets. And in our example, that would be 62.5%. So 481,000 divided by 770,000. And a rule of thumb is that this ratio should be anywhere from 0.4 or lower. So let's do some practice. I want you guys to find the debt to equity ratio and the debt to asset ratio, and then explain whether it's good or bad. So I'll give you guys about a minute to do that. Pause the video and unpause when you're ready. So the debt to equity ratio is 1.1, and usually this is good because a debt to equity ratio is greater than 0.5, and this means that most of the assets are financed through debt rather than equity. And if you're a shareholder, this is a good thing because your shares won't get diluted. And the debt to asset ratio is 0.523. And this is neither good nor bad because the company ideally wants to have a ratio of below 0.4, but 0.523 isn't too far from 0.4. So it's still acceptable, but it's not ideal. So that's it for this lecture. Thank you guys for tuning in, and I'll see you in the next one.